November 30th, and you know, we were trying to do a goview.com video earlier, and there are technical difficulties. I guess the sound isn't there. I hear it fine, but not everybody does, and so it just proves that you get what you pay for, because goview.com is free, and GoToWebinar, which everybody says is relatively flawless, costs you. So the old adage of you get what you pay for is definitely enforced when it comes to webinar and videotaping software. Anyways.
Data doesn't help either.
No, and remember, GoView's in beta, so you know we'll send them that. But yeah, it's probably a bandwidth issue. You know, if they charge for GoToWebinar, then guess which is getting the bandwidth. So, anyways, what's going on? You got the Fed is stepping in here with 5 other central banks around the globe to flood the system with liquidity once again. I guess they're being creative. Hey, Dr. K, do you know what the details are of all that? Specifically, what are they doing?
Well, the central banks have essentially agreed to lower the pricing on temporary U.S. dollar liquidity swap arrangements by 50 basis points. And what that effectively means is that dollars will be made available at lower rates to Europe, which is troubled very much so at the moment. And these lower rates will be available until February 1st, 2013. So we're looking at about 15 months. And the pricing to this reduced rate will begin on December 5th, so that's just a few days away. Now, in addition to that, the ECB today, interestingly, fully failed to, well, I should say failed to offset its purchases of Eurozone government bonds through its weekly money market operation. In other words, it normally doesn't want to be monetizing debt, so it mops up the excess liquidity every week, but today it didn't. And so that might mean that if they don't step in with, if they don't mop up this leftover liquidity, that means that the new ECB president is potentially ready to accept a monetization of debt. And that therefore will challenge the German view about printing money via these open market bond purchases. And that could therefore open the door to increased QE out of the Eurozone. And thus, that could be why we're seeing gold and silver spike today, as well as stocks. If that door were to really open fully, I think we would see a resurgence of an uptrend in both.
So basically what we got going on today is you get this big gap up, third day gap up. You know, it's definitely in follow-through like territory. But Dr. K, would you call this a follow-through today?
Well, I've gone back through all my data, and that means decades and decades worth. There were only a few rare circumstances where the third day was a viable follow-through day based on the statistics of what the market has told me over the many decades. Unfortunately, today does not qualify simply because there's been way too much volatility in the market, and so the model sees too much risk in calling today a follow-through day. But that said, I would have to say the model is certainly leaning more now towards switching to a buy signal and a sell signal based on the news we've seen today and based on the price volume action that's accompanied that news. And if indeed this means that we're going to see increased QE coming out of the Eurozone, we'll see it in the price volume action of leading indices and stocks.
Right. And today you're seeing gold moving up pretty good, gapping up back further up above its 50-day and above the 10 and the 20-day moving averages. Surprising volume isn't really there, right, Dr. K?
Yeah, the volume on gold and silver, GLD and SLV, are pretty anemic today. But then, it could sometimes take these ETFs a little bit longer to get going, because we could look back in the past of, take GLD. When it's in the middle of a basing pattern, it often doesn't get that big volume spike. Sometimes it takes a little bit more time for it to really work out through its basing pattern so that it can properly set up and issue a more forceful pocket pivot point. And today we don't. It doesn't look like we're going to get or even come close to a pocket pivot point because of the prior downside volume in both gold and silver.
Yeah, and we're still long our small initial position in gold and silver in the AGQ and the BGP that we took here on the pocket pivot. So that was basically taken, I think, on the basis of holding it until you had a violation, I think, in the 50-day. at least. Maybe, I don't know if were we planning to hold that to the 200-day, Dr. K?
That was debatable depending on what happened. If GLD were to have violated the 50-day, then it would definitely be a situational um, type of decision on whether we want to sell half the position or keep the whole thing and wait for the 200. But it didn't. GLD
It
has
didn't.
bounced, and and mind you, we're using GLD as our guide, not SLV. So because GLD has managed to successfully what seems to be bounce off its 50-day moving average, we're holding on to both our DGP and AGQ positions. And again, we've only bought each of those once. We bought those a few weeks ago, and we're going to be using price improvement on both of those to add to our position. So when they hit a certain level, we're going to go ahead and add, and we're going to do that in the weeks and months ahead. Hopefully, we're going to get a nice long uptrend in both gold and silver.
Yeah, and it may turn out that in this kind of market, slow and steady wins the race, and just working a position initially in the precious metals may turn out to be the smart move here. I wonder about stocks, though, because the one thing that bothers me is if the Fed is expressing such a willingness to start printing again and basically not waiting for the Europeans to come up with a solution, just stepping in right away. What does that tell you about what they knew in terms of how bad things are in the credit markets over there in Europe and elsewhere? And does more QE solve the problem? So, they're making it easier for people to borrow money who've already borrowed too much, and so you get back to this kicking the can down the road. And if this leads to a sharp devaluation in the dollar, is there potential for realization by the markets that, hey, these guys are going to print forever. The dollar's toast. I'm out. And you start to have a run on the dollar. Do you see that as any potential, Dr. K?
Well, they're very worried. The Germans are, of course, worried about the Weimar Republic, what happened in the 1920s, and they don't want to get into a situation where you have hyperinflation and plummeting commodity values, massive devaluation. And that is the issue. That's the burning issue: is how much QE is too much QE. And the Fed is, I guess, more willing to create this monetization of debt than the Germans are. So there is that tug of war going on, and the way things look, we're going to just have to see how this plays out, because it's very difficult to know how far the Fed is willing to push QE compared to the Europeans. So we'll have to
Right.
see.
Yeah, I'm also reading that this is a weaker form of QE. So a couple things I noticed, if you look over here on the left side here, I'm looking at some of my quotes. I think it's interesting on the day where you have the Dow's up 3.6% right now, the S&P up 3.47, Nasdaq up 3.5, NDX up 3.33, and so on. You're seeing stocks like Amazon is up 1.63%, Apple is up 1.62%, Baidu pushing the most, up 4%. So if you're short any of these things, it's not necessarily clear whether you'd be stopped out. CRM's one of the stronger ones, up 5.79% today. But let's look at some of these patterns here and where these things are. I do think it's interesting that you're seeing a little bit weaker action in some of these leaders that have been weak as of late relative to the mad bounce you're seeing in the market in general. And so, if we look at Apple, all you're doing here is you're rallying up into, I thought that the 380 level might be resistance. It turns out so far today it is. You're below the 50-day and also the 65-day moving average. Notice now how all of the moving averages, the 10-day, the 20-day, the 50-day, 65-day exponential, and the 200-day just starting to roll over. So now you've got all these moving averages rolling over. This is a logical bounce to me. So the interesting thing here is the technical position of a lot of stocks on the short side, if you're looking at that side, and right now I'm open to either side. I am short a little bit and actually not doing so badly considering that the market is up as much as it is. But I think some of these things have to be looked at, and you have to keep this in mind because you won't make money shorting if you're going to be reacting to a big break. You kind of have to be on top of it as it may be occurring. So I'm kind of watching this. I think that we can be very happy being long precious metals, and the fact that the GLD was not stopped out on us by violating the 50-day moving average is a great illustration of why Dr. K has defined a violation of a moving average the way that he has. There's a certain statistical rationale to it in terms of not getting shaken out on a move below a moving average. And you have to remember that most people are aware of moving averages, so it would stand to reason intuitively that little moves below a moving average can fake the crowd out, and so you have to account for that. And I think the way a violation technically should line up. So in the GLD, for example, where you should have closed, but you have to close below the first close, the intraday low of the first close of the day. So right here, you'd have to close below there. You never got there, or move below there rather, and you never got there. So I think if you're going to play QE, that's probably your best bet. And if you look at gold, the pattern here, you got a cup and a handle. You come up the right side, a little better volume on the upside on the weekly chart, and look at the pullback. You pull in down to the 10-week line. You make a little handle. So now gold is trying to work on a cup with handle formation. Maybe this is positive for further upside. I think with the Fed being willing to print so easily, it tells you that precious metals are probably going higher. What it means for stocks, though, is going to be interesting to see. And like Dr. K says, we'll just see how things pan out. All I know is what I'm observing today. And so if I continue down my list, you can see I think Apple almost shortable today using the high of the day as a stop if you wanted to, if you're oriented that way. You can't get your head dinged around trying to short the market over and over again. But if this thing breaks, you're going to make a lot of money pretty fast. You see Amazon, there's kind of this, this little trend line it's following on the upside, trend line resistance as it's pulling up. And so really you're seeing volume dry up on a wedging little rally. My guess is this will eventually break unless this rally continues. So you got to watch what the general market does, of course. But then you have Baidu coming right up into the 50-day. Remove that, get rid of this pen. Coming right up into the 50-day moving average. Notice the 65-day exponential, it's the black moving average up here, and it found resistance somewhere in there. But you can also see there's a little bit of overhead in here that comes into play. So a logical point for it to rally. Is this a shortable spot? It could be. So you really have to be attuned to this, and I think don't try and force it one way or other. Just be open to what you're seeing and whether you want to act on it. And if you do choose to act on it, then you need to have your stops. And so for me, it's very simple to come in here, bang, 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 test some shorts using the high of the day. I even came after Netflix. For those of you who were able to watch the GoView video, this morning in the stock, I had a little position. It jacked up a couple of points. So I went heavier on it, and it rolled over. It's kind of saving my butt today in a lot of ways, but not that I'm really in any kind of trouble. That everything is within parameters and within the risk parameters that I would prescribe taking a short position. Obviously, if you're using, let's say on CRM, if you shorted yesterday and using the high of that day as your stop, you're stopped out immediately. If you're using 3 to 5%, you're getting pretty close to it right now, but we'll see how this thing acts going into the close, if the index is weakened or not. But I think this is a weak stock because of the high volume break here. I think it tells you for the most part that institutions are now looking to sell the stock and not necessarily accumulate the stock. Doesn't mean it can't noodle around, build a whole new base, and come out eventually. But on this break, I think weak volume rallies are always going to be suspect when they come up. But I think you're either coming into 120, you're either going to stop somewhere in here around the 10-day, or you're coming into 120, or you might be coming up to the 50-day and the 65-day. But notice how here you have all the moving averages starting to roll over. Same situation that you're seeing in the other stocks. Same situation you're seeing in Baidu. You can throw Apple in there too. I think LinkedIn is interesting just because it's turned into such a doggy stock, and maybe in a weak market environment, assuming this rally can't hold. And of course, we don't have a follow-through today, so we're not making the assumption that the market direction model is on a buy signal. Right, Dr. K? No buy signal, right? But it could change any day.
We're going to stay on cash, but we don't. Here's the thing: if we get a constructive pullback on light volume that the model senses is truly just a pullback in the middle of a continued uptrend, the model doesn't have to see a classic follow-through day. Because remember, these are unusual times. The model does factor QE into the mix. So, yeah, the buy signal, I mean, it could come as early as tomorrow. Doubtful, but the model is still waiting and watching.
Right. So that's what I'm seeing on the short side. And take To me, it tells you that things aren't so cut and dried here. You may have a situation where it remains a market of stocks rather than a stock market. But watch how these indexes act into the close. I mean, this all seems too obvious. Here we go again, QE to the nth power again, and everything's just going to continue rallying forever. I think if they're printing money, gold and silver go higher. I want to be long those, and I like the action here, and glad we didn't get stopped out, as I said. But stocks, I think the question is out because what's acting really well? Dutch K, you picking up anything on your screens here this morning on the buy side?
On the long side, not really. I think it's just a little too premature. I mean, there are a few stocks that are doing well, like Q-Core. I mean, that one just has continued to do very well. PNRA, which we sent out a report on a couple days ago, that's going to new highs today. So you have to pick and choose in this market, certainly, if you're going to play the long side. But that may change. We'll see how stocks shape up in the ensuing days. I mean, it does look, though, like this could be potentially a repeat of early 2009, where we saw a lot of junk stocks lead the rally.
Yeah.
And today, on my screen, the stocks that are up the most are sort of, they're not leading stocks, and the ones that are supposed to be leading are only up fractionally compared to what the major indices are up.
Yeah, I mean, you see things like this, RBN, Robinson Myers, oil stock is jamming pretty good today. But it's a thinner stock. You see some of those sorts of things, Other than that, some oil stocks have been acting well, but I haven't seen anything that I really want to step into and buy here. I tend to see things more than I want to short here, based on the types of rallies that I'm seeing in the areas that they're rallying up into. So that's kind of how I'm looking at it. So, the easy way to test any short on any given rally day is if it's up, you short it, use the high of the day as a quick stop, or use a 3 to 5% stop. It's pretty simple. And if you take 10% positions, I think you're not really going to get hurt too badly. So somebody's saying they lost the sound. Can you hear me okay out there, everybody?
I can hear you fine.
Yeah, so it's probably your system there. Everybody hears me fine. There's always somebody out there with some kind of bandwidth issue. It's not all that even. Yeah, okay, we're going to get 500 email or IMs coming back. Very good, thank you. I know everybody can hear me fine. So anyways, that's really all I'm thinking today. Dutch, do you have any further thoughts? Let's get some questions real quick.
I wanted to mention, make one quick mention about the violation that GLD did not violate the 50-day. But if you go, just so that people are very clear on how to use the rule, if you go back and look at GLD in June of this year, it did violate the 50-day there. It went just undercut.
Close here, right.
Now the option there, see, because you're still in the basing pattern, the base is constructive. In other words, it's gone once it turns pretty sideways, the 50-day will have a tendency to flatten out, and it could violate it. But that might not be a violation you want to sell into, because, in other words, you're still within that basing pattern. On the other hand, you could very well have sold on that violation. That would have been on June 27th. But then you'd turn right back around and you would buy the pocket pivot on July 11th or July 12th, either one of those, because that qualifies as not just a pocket pivot but base breakout on July 12th. So you can handle a violation a number of ways. In fact, in some cases, I've had stocks that violated the 50-day and then on that very same day turned back around, closed at the peak, and issued a pocket pivot. So the action there would have been you sell during the day and then you buy it back at the close when the stock proves a pocket pivot at the end of the day. It's psychologically tough to do, but statistically speaking, that's exactly what you should be doing, assuming the stock is a leading stock.
Yeah, good point though, that with a stock that's basing or ETF that's basing, the 50-day will catch up to it and start to flatten out, and you can get a little bit of a wiggle below the line a few times. That's true. So in this position, the 50 days actually turning down. So, but 200 days remains up. So it looks okay. 65-day is flat. 65-day exponential, and you're moving actually off of that today. So it looks okay so far. We'll see what happens. But like I said on the weekly chart over here, not a bad pattern. What else? Okay, some questions real quick. People asking about Biogen. You know, we had a pocket pivot here. The one thing with that is a little bit of a V shape. Notice how it backed and filled to correct that a little bit. Now you're moving out again. So it's acting okay. There's news out today that some drug they have or something, some product they're working on is being fast-tracked or something to that effect, or they want to sue it. I forget. Anybody who know the news on Biogen out there? But whatever it is, it's driving the stock higher. So SWI is another one everybody's asking about. Solar winds, and of course that's breaking out again. It was in a, this stock's a little thinny, so I know it trades about $1.2 million a day, but it's still just barely like 35, 37 million dollars of volume, dollar volume every day. So it's not a big one, but it's acting well, you know. So nothing else to say. You got FIO coming in here. And it makes me think of Jack from the Beanstalk, Theo, File, Fo, Fum, or whatever. But today, you know, you're just jerking around this pattern, so you're kind of gapped up after 4 days. So you're not going to come after it here. There's no buy point. So just let it settle out if you like it. I mean, I like it. I like the story, but, you know, they just dumped a bunch of shares. It wasn't priced so great, and I think that's going to have to be absorbed. It may take some time. And, of course, we're not sure if the market environment is correct. Somebody's talking about this one, Acorn. I seen it. It's a cheap stock, so not something we necessarily play. I was just trying to break out. AZO, AutoZone, it's just basing, but it's kind of a sloppy base. I mean, trying to break out here and not going anywhere. So IBB sector looks like it might lead the market out. Well, you have a few names in there. There's, you know, Biogen, there's Questcor, there's a few others I've seen that are acting okay in the medical area, but I don't know if that's going to lead the market out. So, but if they're acting okay and you own them, you don't have to sell them. Somebody's asking about our thoughts on CF. I don't really have any thoughts on CF. It looks like it wants to go lower. So I say short it, use it 200 day as your stop. If you really hate it, if you love it, then buy it and use the low of today as your stop. Okay, how's that? Otherwise, I don't really. It's looking more like a short all the time, actually. So here's your weekly pattern. Is it a head and shoulders? No, because the right shoulder is higher than the left shoulder. I don't really like that. But, you know, sometimes in commodity stocks, that pattern can work. It's under the 200-day now. So I would look at this more as like a late-stage V-shape cup of handle as improper fail. So yeah, if you hate it, you can short it, use the high of the day as your stop. If you like it, you can buy it, use the low of the day as your stop. So I'll keep an eye on this one. It is on my short selling list along with the other, my watch list rather, along with the other fertilizers, all of which have been acting doggy. So I don't typically hold shorts overnight, but I have. The interesting thing is I held relatively small short positions only twice in the last week, and once was over this past weekend when they gapped it up big on Monday, and the other one was overnight last night. So I had this gap up in my face this morning, but not really a problem because they don't have me down. I'm running very close to the flat line today, so it doesn't really bother me too much, but it does point out how it's tough to hold anything overnight. I mean, I think even long, you know, how do you know you don't get a big gap down? There's so much weird news out there. So we got 7 minutes left, so we're just going to pummel through some of these names. Anyway, it's just trying to get back above the breakout point, just sloppy and choppy. You got anything to say, Dr. K? Lulu I'm watching actually as a short sale potentially here. I think it's pushing up in here. They come out with earnings though in the early part of December, I think, December 8th or something like that. But you notice how it has broken down. You're looking at a weekly chart. It's kind of starting to look a little bit like some bizarre late-stage double bottom that has failed. So it is a failed pattern. You're seeing the 50-day or the 10-week coming down towards the 200-day. So looking doggy, and maybe it has topped, you know. But this is what they'll start to look like when they do top. The only problem with Lulu is it's starting to look a little choppy around here, I remember, and it never topped. Here we're getting the same thing, but this, I think, is a lot sloppier. This is an exponential or logarithmic chart, rather. So you can see that as the price moves up, the distances between the prices compresses, and so this looks pretty wide compared to this. But you can see it's adjusted on a percentage basis, so it is actually quite a bit wider than down here. So it's possible this could be the beginning of the end for Lulu. Who knows? But right now it's acting pretty weak. Don't like it. Wouldn't buy it. Earnings tomorrow on Lulu, by the way, somebody says. Thank you. Rax. La la la. You know, trying to break out, backs down, comes back up. It's like every other stock. It's just chop and slop. Anything I'm looking at on the long side is just chop and slop. Um, yeah, I'll retake a short position the next day and continue. I usually try to because that's if you look at some of these patterns. Let's just even look at Green Mountain. So, and I can just go over real quickly one of the ways how I played it. You know, on the way down, it's shorting it up here, shorting it up here. And I even think on this little blip, I was in and out a couple times maybe, and then boom, it breaks. So it undercuts the slow. I cover and hang out, and I test it on this day. It doesn't go lower, cover it. Next day, it moves up a little more. Goes short here. Boom, the thing breaks down, goes to the 200-day moving average. I start to cover in here. Pushes back up into the 200-day moving average. I'll put it out here. But I might be trying to short on this day here. It doesn't really go anywhere for me, so I cover it. But you can see that the movements, for the most part, are contiguous. In other words, the daily range here overlaps with these daily ranges. So you do have a chance to come in roughly at where you might have covered if you covered near the lows of the days. And of the low of the day rather, and I find that if I linger too long, a lot of times they just run you the other way. I feel better more or less day trading on the short side relative to being long. It's completely different the way I approach it. And I think in this market, you know, the fact that I've held overnight, not big positions, I'm not getting creamed, but you know, sitting through big gap ups, and they're news related, but you know that's what's going to happen, and so I account for the risk on them. What am I willing to stomach? And I decide that ahead of time and take my shots, and that's just the way it works. If you think that short selling is for the faint of heart, guess again. But it doesn't really bother me, so we're doing okay. You know, we're actually close to the flat line, about 1% down, and that's just fine right now, given the fact that the market's up as much as it is. So yeah, I do try not to hold positions overnight. I can tell you one thing: doing it on the short side over the last week has not been the smart thing to do. So, but not a killer either. So. Titco is trying to break out of this cup of handle, but it broke down. So, you know, how do we know it's not a pod? Maybe this is a pod, you know, and it has those features straight down, straight up. Starting to look that way to me. Maybe this is a shortable pattern. I'm following this. So it goes alternately on my buy and my short list. But right now I'm just kind of keeping an eye on this thing because it could be in trouble here. A lot of times on a pod, when it breaks down, it bounces off the 50-day. A lot of times you use a 20-day as a place to try and short it, so you could theoretically try and short it here. I mean, the big move in the market today makes me nervous, but I don't know. I mean, I've been watching this, and I may try it at some point. I don't know. So, but it does have pod-type characteristics. Big, ugly thing. Nice move, big, ugly thing. See, that's the essence of a pod. How many weeks are in this one? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I think I'm counting that right. 15. 16, 17, 18, 19 weeks in the pod. That's kind of what you want to see, you know, somewhere around 20 to 30 weeks. The quicker down and up they go, the better they are in terms of failing, I think. So, Netflix, we were talking about shorting it. Here's a problem. I think Netflix is going lower. So, that's my view here. You gap down here, you have this really rolling thing. So right now, if you want to short it, you can use a 10-day at 71 and change as your big stop on the upside. I'd use a high today at 69.32. This one I came after. Volume's starting to pick up relative to yesterday. But these guys are doing a secondary of debt and stock, I guess, or whatever it is. But, you know, the bottom line is for Netflix securities, I think the chart is already telling you that the supply-to-demand equation is leaning very heavily against the odds of the price going higher from here. You're putting more supply on something that's telling you it has too much supply because supply is exceeding demand, and that's what this chart is telling you. There isn't enough demand to absorb the stock that people want to sell, including the company now. Or, you know, before it was just people who owned it, and that was enough to drive it down about to 1/5 where it was at the peak. And I notice it's blown apart here. I'm short the stock actually as we speak, and I think it goes at $40, you know. But they're just flooding the market with more supply in a situation where you can see from the chart there's no demand. So, in your book, Dr. K, in your book, you indicated you held a number of stocks. This year you seem to play a very small number. Who's that? Me or Dr. K? Dr. K, you still use 10 to 12 names, right?
Well, not in a year like 2011. There just aren't. aren't many opportunities on the long side. If we were in a more classic bull market where the window's clearly open, and that window was clearly a lot more open in the 90s than it has been in the last 10 years. But that said, if you go back, for instance, to late 2006 and you look at September, October, November, you had a solid 3-month window that was wide open. In fact, it didn't take me very long to get on full margin with a whole pallet of names. I think I was holding about 14 names and force feeding the money into the strongest names. So out of those 14, I might cut the weakest one in half to make room for a new one that's breaking out or pocket pivoting. And I had that kind of dynamic rhythm during those 3 months and was able to run my account up over something like 115%. Just through that natural dynamic of using pocket pivots, which gave me an added advantage compared to using more standard methods of buying breakouts. So, in 2011, I think the largest number of names I've had in terms of stocks on the long side is probably 3 or 4. That's it.
Yeah, and mostly this year we've made money with gold and silver. Someone asked if this is the toughest year in our career. Well, we're actually up, so the money we run together, we're up, I guess, somewhere around 40-something%. So we're doing fine. So it's not the toughest year de facto, but it's a tough environment. We know a lot of people are having trouble. So if you're having trouble, you're not alone.
As being objective, as far as the challenge that various years present, I remember hearing that Bill O'Neill said at the end of 2009, he said 2009 was the most challenging year of his career. And that made sense because it was a year led by junk stocks. Everything was turned on its head. Long-time indicators that stopped working because of the quantitative easing effect. I think you would agree with me that 2011 is more challenging than 2009 on an objective basis, just simply because it's been the first 6 months were trendless. Then you had August where the market just completely got slammed, caught a lot of people off guard. And then since then, the market has been, if you look at a weekly chart for the NASDAQ, it displays this very nicely. Since August, the market has really been in one of the most volatile, trendless periods that I've seen on record. And that is why there's a group of trend following wizards that get tracked. It's about, I think, 21 different guys that were different ones interviewed in Jack Schwager's books and whatnot. And they have exemplary track records. A lot of them have been in the business for over 30 years. And collectively as a group, they're all down, I think, double digits this year, and most of them are down. There are only, I think, 2 out of the whole group that are up this year, and they're only up maybe 5 or 6%. So it's quite a brutal year for trend followers. There's no doubt.
Yeah, I think we've been able to put it together pretty well, though. And you can see it on this chart. That pretty much tells the whole story. I mean, look at the volatility. But even notice, the volatility since the lows in August, just really choppy, chop, 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 chop. And I know that everybody's felt that. And that just kills you. If you're the type of, someone made a comment about, I forget, getting a headache or something, getting zapped or something if you're using O'Neill methodologies. I don't know, we're not getting zapped this year, we're up. So it does make it tougher, so you do get zapped in the sense that they make you work. But Dr. K, putting our heads together, are able to tackle this market and make money. And I think that may be the deciding factor.
Yeah, when the market is as choppy as it's been, that's where experience can help one not overtrade. It can help one also position size appropriately. So, for instance, the long positions I have taken this year are generally on the small side. In fact, they're all subpar of what my normal position size would be, with one exception. That was MCP, which I bought a number of times. It just kept hitting its price points. So that was probably my biggest position this year. It worked out very well. But the stocks, the number of stocks that did not work out, where I was forced to sell them, usually within 5% of having where I bought them, they were small positions, and so pretty not very material to the performance.
Somebody says we're up because we're smart. No, actually, I think it's because we're stupid and we know it. And we know exactly where we're stupid, and that's the advantage, right, Dr. K?
that is the paradox. Knowing exactly
that is
where
the paradox.
you're not going to try to teach them what you think.
Like, yeah, we can see what situations we're going to walk into to get our head handed to us so we avoid it. So what we're able to avoid, I think, in most cases this year has proved to be a big part of it as well. So anyways, that's all we got for now. It's a tough market. You know, what are we looking at? Well, gold is acting okay, but we know the Fed is going to step in and do their thing at will, and we'll just see where this goes. So we'll just be watching it. You know, we were planning on having a webinar today, but when the goview.com, we had a lot of people emailing about that, and even Dr. K was having trouble viewing it. We decided to do this. We'll see if we have another one this week, because you don't know where this is going. It could turn out to be a big non-event. So far not a buy signal, but the day is still young. We still got 3 hours of trading left. So thanks for showing up on a short notice. This will be posted up on the website once we get the recording down, and our trusted Director of Operations and Trading, Bill Griffith, gets that video up as he always does in rapid fashion. All right, so thanks everybody for showing up. We will catch you later.
So long, everybody.